Let's talk about escrow account calculations when purchasing a home. So, escrow account calculations for purchase loans. I'm going to speak specifically to Texas. This should apply for the most part, everywhere. But the reality is, some places may have you pay taxes a little different time. So, I understand that this is mostly true, but for Texas, again, conceptually, it's going to be accurate for everywhere. But let's talk about escrow accounts. So, first and foremost, what is an escrow account? An escrow account is going to be, think of it like a piggy bank with your name on it, where at closing, some extra funds are going to get collected and go into that piggy bank that the lender holds. The servicer technically holds it, but the lender is going to hold that money and they use it as a cushion for just things that may happen in the future. So escrow accounts for government-backed loans, that means FHA, VA, USDA, things like that, they're mandatory. There is no way around it. Escrows are required. For conventional financing, escrows are going to be required when there is less than 20% down. Truthfully, there are some exceptions that can be made when somebody puts down, say, 10%. But just generically speaking, let's go with 20% down for conventional financing. That's when somebody has the option or ability to potentially waive escrows. But if you're putting down, say, 5%, Fannie Mae, Freddie Mac, conventional financing, conforming, you're going to end up having an escrow account. So escrow accounts, and for what we're talking about, it's taking extra money for taxes, property taxes, and extra money for homeowners insurance, and taking that and collecting it at closing and putting that in the piggy bank so that the lender has an excess amount on purpose. So how do we figure out how much to collect at closing? That's the question. So escrow account calculations for purchase loans. Let's talk about that. The easy way, the generic way, is to say, cool, at closing, you're going to pay 12 months of your insurance. That goes straight to your insurance provider. You pick. I don't care. Farmers, Allstate, local broker, whatever you want to do. 12 months is going to go out the door to pay in advance for that 1 year of insurance. That's not part of the escrow accounts. That's just part of the cost of having the homeowner's insurance to make sure that if your house burns down before you even get to drive and see it after it closes, that you're at least covered. So that part goes out the door. It is, kind of considered part of the prepaids. That's the fancy word for everything we're talking about. But the escrow account itself, the easy way to do it is take 3 months of taxes and 3 months of insurance. So whatever your property taxes are, monthly, 3 months of that gets collected and 3 months of insurance. Truthfully, that's not exactly right. That's the rule of thumb. That's the number that ultimately gets really close. That's the back of the napkin math that says, cool, if my insurance is $100 a month, 3 months of that is $600. By the way, that'd be really inexpensive. So good for you if that's let's say it's $300 a month. Let's go that number. $300 a month. And if for 3 months, that's $900 that gets collected. If the property taxes are $1,000 a month, right? So it's 12 grand annually. Let's say it's $1,000 a month. 3 months is about 3 grand. So all of a sudden, the 3 grand for taxes and the $900 we just did, $3,900, round numbers, that's what's going to go into the escrow account, the piggy bank. And so the bank then has this, and they keep that extra amount. And here's why. When you close on a mortgage, you pick the month. I don't care. Let's say you close in June. Your first mortgage payment, the vast majority of the time, is going to be skipping a month. So if you close anytime in June, you get to skip July. Your first payment's not due until August. So you don't make a mortgage payment until August when somebody closes in June. That means for sure all of July, there's no payment being made. Well, the mortgage company wants to make sure they have enough money to make sure that that's kind of that gap where they're not getting that incoming cash. There's enough money to cover that for that gap. The other part is, let's say you close June 1st. There's a whole month of June where there's no money coming in. So you could argue that potentially 2 of that 3 months is already getting collected just to pay for the months where there's no cash coming in the door for those things. So the extra 3 months they have is, what if this time next year, so the anniversary of the purchase, if taxes went up, or insurance went up, they want to make sure they have that extra little bit in the piggy bank so that when that bill comes around for the insurance, they can write the check. Even if it went up $200 or $300 a month, they got that extra amount in that piggy bank. And that's why they collect that extra escrow amount. So for the calculations at closing, like I said, 3 and 3 is a good round number. The reality, how do they do it, It's a fancy formula. We're not going to go into it. I did it once in my career, and I've done this for since 2003, so over 20 years. I did it once because I built a worksheet, and we still use that worksheet to this day internally, and it calculates the escrows, and it's complicated. I loved it. It's fun. It did it as a challenge, but it was really fun. But it is regulated by the federal government, and it is to the picture perfect accurate. So what you see is instead of the 3 and 3, you're going to have a number that they collect, and then there's going to be what's called an aggregate adjustment. That aggregate adjustment is where they come up and say, like in my example, if it's June 1st versus June 29th or whatever, like that's a whole month. So that aggregate adjustment accounts for those type of differences. And it's going to say, here's a credit. So it's going to charge you money. And then you get this aggregate adjustment on a separate line item that says, here's what it is. And again, to make sure it's very clear, when your insurance gets paid in advance, let's say in my example, somebody closed in June, that's when they first start making their August payments. They already have, like in my example, let's say 3 and 3. So if they got 3 months of taxes, of insurance in this example. So they close in June. I don't care when, let's say June 1st. They close June 1st. No mortgage payment's been made until August 1st. So let's count on our fingers like we're in grade school. So that's August, September, October, November, December. So there's 5 for the rest of the year. January, February, March, April. So there's 8 or 9. So let's say April. Why did I start at April? Because in May, the mortgage company is going to get a bill from the insurance company saying, hey, remember that June 1st check that we collected at closing from the borrower and we got paid in advance? May 1st, they're going to say, hey, that's coming due. You owe us the money if you want to keep insurance on this home. So in my example, the 9 months, right, from August through next April, by the time the April 1st payment gets made, that's the 9th payment. Well, if at closing they collected 3 extra months of insurance, 9 plus 3 is 12. 12 months of insurance, meaning when the bill comes in the door in May for that insurance, the mortgage company has the ability to send that check over to the insurance company. And let's say the insurance went up a little bit. Remember, they got that extra 3 months of taxes. So they got a few extra bucks in there for the cushion, and they can send that out, whatever that extra is. So they can make sure that insurance is paid in full and taken care of. Similar for taxes, a little more complicated again, going for Texas here. Texas is taxes are in October. And the reason I say the 3 months for taxes at closing, the reality is if it's in June, they're probably collecting 7 months of taxes. But the reality is you as the seller, or pardon me, the buyer, the buyer are only coming out of pocket that net 3 months or close to it. And the reason being is when the taxes come due, and they come due in Texas, they come due in October. They're not late until January, but people are like, I pay my taxes in December. Look, they come due in October. And when they're due is when the mortgage company needs at least have the money on hand to be able to pay them. So by the time October hits, they want to have at least 12 months of taxes collected. So that means come October, they need to have 12 months, which means September, in my example, September and August, or August and September, however you want to look at it, are really the only 2 months that they have to collect payments from the borrower in this example. If they close in June, August and September, the 2 payments, they need to have 12 months worth of taxes to be able to write a check for if they want to. And that's why at closing, they would collect 10 months of taxes. I may have said 9 moments ago, or 8 or 9, but it's 10. They need 10 months of taxes collected at closing. And the way they do that, they're going to basically get 5 from the sellers because they've owned it from January through May. In our example, so January through May, they're going to get 5 from the sellers. And then if you get that ballpark 3 extra from you, that makes it 8. And then the August, September is 9 and 10. So they're just a touch short. But again, the aggregate adjustment makes up for all this to where when they collect those closings, or they collect money at closing, they have enough so that by the time they want to cut the check, which will probably be in December, they can do it with 12 months of taxes. So this is a long explanation of this, but it's the truth, right? It's how escrow accounts are calculated for purchase loans. So again, if you have questions, and this is again for Texas, but generically it's 3 months and 3 months. That's the very easy way to do it. But everything else, this is spot on. It's accurate. It is complicated. At the end of the day, just know that no, every mortgage lender in America has to operate under the same guidelines, and every title company is going to make sure it's all collected. And the escrow accounts are heavily regulated, so it's not going to get jacked up. At least it shouldn't, right? If somebody did something stupid, and I don't know how that would happen, but maybe there is somewhere an example where it could. But the reality is, you don't need to worry about it, and it's going to work out because it has to. It's regulated. So that is my long answer. If you have questions or really care, feel free to give us a shout here at the Mortgage Mark team. We are happy to answer your questions. And when you think mortgage, think Mark.